The 2026 housing market can no longer be explained by national averages or simple headlines. While broad data may suggest stability, the reality on the ground is far more fragmented. Some cities are holding value, others are stalling, and a growing number are quietly moving backward as affordability limits, elevated interest rates, and rising ownership costs collide with prices set during an exceptional period. This is not a uniform crash unfolding all at once. It is a localized recalibration, happening city by city. Markets that surged the fastest during the boom years are now facing the most pressure as buyer demand weakens and sellers adjust expectations. Zillow's home value trends reveal that price movement in 2026 is increasingly driven by local conditions rather than national momentum. What makes this moment different is that even small shifts in demand now have outsized effects. Buyers are more cautious. Monthly payment math matters again. And markets that relied on optimism, migration surges, or cheap financing are being forced to reconcile prices with long-term fundamentals. In this breakdown, we examine 10 U.S. cities where home values are under the greatest pressure in 2026, focusing on why these markets are struggling and what that signals for buyers, sellers, and investors navigating the year ahead. Subscribe for data-driven housing analysis without hype. We break down real risk city by city, not through averages that hide reality. Number 10. Houma, Louisiana. At first glance, Houma does not look like a city vulnerable to housing decline. It is not a speculative hotspot. It did not dominate national real estate headlines during the boom, and it lacks the kind of investor frenzy seen in larger metro areas. That surface calm, however, is exactly what makes its housing pressure in 2026 easy to overlook. Before the national housing surge, Houma's market was slow-moving and closely tied to local employment and income levels. Home values tended to rise modestly, reflecting what residents could realistically afford. During the boom years, prices increased more rapidly, not because of a fundamental change in Houma's economy, but because national housing momentum lifted nearly every market at once. As interest rates rose and affordability tightened, that momentum faded. Zillow home value trends now show sustained pressure rather than a quick rebound. Homes are spending longer on the market, and sellers are increasingly adjusting prices to attract a smaller pool of qualified buyers. Demand has not vanished, but it has thinned enough to shift negotiating power decisively away from sellers. Buyer psychology in Houma has changed sharply. Buyers are cautious about committing to prices that assume long-term appreciation in a market with limited population growth and narrow economic diversification. Monthly payment calculations matter more, and buyers are far less willing to stretch financially when alternative markets offer similar pricing, with stronger job prospects. From the seller's perspective, resistance is common. Many homeowners remain anchored to peak-era valuations, even as holding costs accumulate. Insurance, taxes, and maintenance continue regardless of market conditions, increasing pressure the longer a property remains unsold. Houma matters nationally because it illustrates an early-stage housing unwind. When price growth outruns local fundamentals, corrections tend to be slow, persistent, and difficult to reverse once affordability tightens. Number 9. Lake Charles, Louisiana. Lake Charles is another market where housing pressure in 2026 is not driven by speculation, but by fundamentals quietly slipping out of alignment. On the surface, it appears stable: a small metro, limited new construction, and no dramatic boom and bust headlines. But Zillow's home value trends reveal a market under sustained strain. Before the housing surge, Lake Charles operated as a locally balanced market. Prices reflected regional wages, and demand was largely driven by residents rather than outside buyers. During the boom years, values rose faster than historical norms, pulled upward by national housing momentum rather than local economic expansion. As borrowing costs increased and affordability tightened, that momentum stalled. Zillow market indicators now show longer days on market and repeated price adjustments, signaling that sellers are competing for a shrinking buyer pool. The issue is not excess inventory in absolute terms, but insufficient demand at current price levels. Buyer psychology in Lake Charles has shifted toward caution. Buyers recognize that price growth is no longer guaranteed and are increasingly unwilling to stretch financially. With limited job diversification and modest population growth, buyers are factoring long-term stability into their decisions rather than short-term market optimism. Sellers face a difficult adjustment. Many are anchored to peak valuations and expect patience to be rewarded. However, holding costs continue to accumulate. Taxes, insurance, and maintenance costs add pressure month by month, making resistance increasingly expensive. Lake Charles is nationally significant because it highlights a critical pattern emerging in 2026. Markets don't need oversupply to decline. They only need prices to remain misaligned with what local demand can sustain. Number 8. Lafayette, Louisiana. Lafayette's housing market in 2026 reflects a classic post-boom correction that is often overlooked because it lacks dramatic headlines. On the surface, the city still appears stable, supported by local employment and a steady pace of life. But Zillow's home value trends point to a market under persistent pressure as prices realign with economic fundamentals. Before the national housing surge, Lafayette's market was defined by affordability and slow, predictable growth. Home values moved largely in step with local incomes, and demand was rooted in residents rather than speculative buyers. During the boom years, however, prices accelerated far beyond historical patterns, lifted by low interest rates and nationwide housing enthusiasm, rather than structural changes in the local economy. As borrowing costs rose and affordability tightened, buyer behavior shifted. Zillow market data now shows homes taking longer to sell and sellers making incremental price adjustments to stimulate interest. The correction is not sudden, but it is consistent, reflecting a market where demand no longer supports peak pricing. Buyer psychology in Lafayette has become increasingly pragmatic. Buyers are scrutinizing monthly payments and weighing long-term affordability rather than assuming appreciation will offset higher costs. Many are willing to wait, knowing that inventory exists and negotiating power has shifted in their favor. From the seller's perspective, adjustment has been slow. Homeowners often resist lowering prices, hoping conditions will improve. But ongoing expenses, insurance, taxes, maintenance, continue regardless of market sentiment, adding pressure over time. Lafayette matters nationally because it demonstrates how markets that surge without parallel income growth often experience prolonged, grinding corrections rather than quick rebounds. Number 7. New Orleans, Louisiana. New Orleans is often discussed as a city that defies typical market logic. Its cultural identity, historic neighborhoods, and global recognition create a perception of permanent desirability. But housing markets are ultimately governed by economics, and Zillow's home value trends show that New Orleans is facing sustained pressure in 2026 despite its reputation. Before the housing surge, New Orleans already carried higher ownership costs than many southern cities. Older housing stock meant higher maintenance expenses, and insurance costs were a persistent factor in monthly affordability. During the boom years, prices rose anyway, lifted by national housing momentum and cheap financing rather than improvements in local income levels. As interest rates increased and affordability tightened, demand weakened. Zillow market data now reflects longer listing times and growing seller flexibility. Buyers are increasingly selective, comparing New Orleans to other metros that offer newer homes and lower long-term ownership costs at similar price points. Buyer psychology has shifted toward caution. Buyers are running full-cost calculations, mortgage, insurance, taxes, and maintenance before committing. The assumption that prices will continue rising no longer offsets these costs. Many buyers are choosing to wait rather than stretch financially in a market with uncertain appreciation prospects. Sellers, meanwhile, face mounting pressure. Many remain anchored to peak-era prices, expecting patience to restore value. But holding costs do not pause. Insurance premiums, property taxes, and ongoing repairs continue regardless of market conditions, making prolonged resistance increasingly expensive. New Orleans is nationally significant because it illustrates a growing constraint across U.S. housing markets. When ownership costs rise faster than incomes, even highly desirable cities can experience persistent price erosion rather than quick recoveries. Number 6. Austin, Texas. Austin's housing market is one of the clearest examples of post-boom recalibration in 2026. For years, the city was framed as a place where prices could only move in one direction. Strong job growth, tech expansion, and lifestyle appeal created a narrative of permanent demand. Zillow's home value trends now show that this assumption is being tested. Before the surge, Austin already faced affordability challenges, but demand remained strong. During the boom years, remote work and ultra-low interest rates dramatically intensified that demand. Prices rose rapidly, often detached from local income growth, as buyers rushed in expecting long-term appreciation. As borrowing costs increased and return-to-office policies spread, demand cooled. Zillow market data now reflects longer days on market, increased inventory in certain price ranges, and renewed negotiation between buyers and sellers. The market has not collapsed, but momentum has clearly reversed. Buyer psychology in Austin has shifted from fear of missing out to disciplined evaluation. Buyers are no longer stretching based on future expectations. Monthly payment math, long-term affordability, and job stability now dominate decision-making. Many buyers are willing to walk away if pricing feels disconnected from fundamentals. Sellers face a difficult adjustment. Those who bought near the peak often resist price reductions, hoping for a rebound. But rising carrying costs, taxes, insurance, maintenance, continue regardless of market sentiment. Austin matters nationally because it shows how markets inflated by extraordinary demand, shocks tend to recalibrate sharply once those shocks fade. Number 5. Dallas-Fort Worth, Texas. Dallas-Fort Worth is frequently described as one of the most resilient housing markets in the country, and in many respects, that reputation is earned. The region benefits from economic diversity, job growth, and continued population inflows. However, Zillow data shows that even resilient markets are not immune to recalibration in 2026. Before the boom, Dallas-Fort Worth maintained a relatively balanced housing market. Prices rose steadily, supply expanded cautiously, and affordability remained intact. During the surge, demand accelerated sharply, prompting builders to add supply at a rapid pace across suburban and exurban areas. As interest rates rose, absorption slowed. Zillow market reports now show increased inventory, longer listing times, and growing use of incentives, particularly in newly built homes. While demand still exists, buyers are no longer competing aggressively. Buyer psychology reflects this shift. Buyers know they have options and are negotiating more assertively. Sellers, meanwhile, are learning that optimism alone does not move inventory. Pricing discipline has become critical. Dallas-Fort Worth is nationally relevant because it highlights a central feature of the 2026 market. Even strong, diversified metros must reconcile prices with purchasing power once momentum fades. Number 4. San Antonio, Texas. San Antonio's housing market rose rapidly during the surge years, largely because of its reputation for affordability. For buyers priced out of Austin and other Texas metros, San Antonio became an attractive alternative. Zillow's home value trends now suggest that this advantage is diminishing. Before the boom, San Antonio's market was stable and income-aligned. Prices moved gradually, supported by local demand. During the surge, prices rose faster, driven by spillover demand rather than by changes in local wage growth. As interest rates increased, affordability tightened. Zillow market data in 2026 shows longer listing times and more frequent price adjustments. Sellers are becoming increasingly flexible as buyer demand cools. Buyer psychology has shifted noticeably. Buyers are reassessing whether San Antonio still offers meaningful value relative to other markets. Monthly costs have risen, narrowing the affordability gap that once drove demand. San Antonio matters nationally because it demonstrates what happens when secondary markets lose the affordability edge that initially fueled their growth. Number 3. Tampa, Florida. Tampa's housing market surged during the pandemic years, driven by migration from higher-cost states, favorable tax policies, and lifestyle appeal. For a time, demand seemed limitless. Zillow's home value trends now show that this momentum has slowed, revealing underlying affordability constraints in 2026. Before the surge, Tampa was a steady, moderately priced market. During the boom, prices rose rapidly as buyers relocated in large numbers. Low interest rates matched the true cost of ownership, allowing buyers to stretch further than they otherwise would have. As financing tightened, the market changed. Zillow market reports show increasing inventory in certain price ranges, longer listing times, and more frequent seller concessions. Insurance costs, property taxes, and general cost of living increases have become central to buyer decision-making. Buyer psychology has shifted decisively. Buyers are now running full ownership cost calculations rather than assuming appreciation will offset rising expenses. Many are willing to wait or negotiate aggressively, knowing supply has improved. Sellers, meanwhile, face growing resistance. Listings that once attracted multiple offers now sit unless priced competitively. Carrying costs continue regardless of market activity, increasing pressure over time. Tampa matters nationally because it illustrates a growing vulnerability across destination markets. Hidden ownership costs can quietly erode demand long before headline prices collapse. Number 2. Miami, Florida. Miami has long been viewed as a market driven by global demand, lifestyle appeal, and limited supply. While those forces still exist, Zillow data shows that Miami is increasingly constrained by affordability in 2026. Before the surge, Miami already carried high prices relative to incomes. During the boom, demand intensified further, pushing values higher and reinforcing the belief that the market was insulated from downturns. As conditions normalized, the cost of ownership became impossible to ignore. Zillow market trends now reflect slower price growth and pockets of decline, particularly among domestically financed buyers. Rising insurance premiums and taxes have shifted the calculus for many households. Buyer psychology in Miami is now segmented. International and cash buyers remain active, but domestic buyers are cautious and highly selective. Sellers are adjusting expectations as competition increases and demand narrows. Miami's national significance lies in its reminder that desirability does not eliminate affordability ceilings, even in globally recognized markets. Number 1. Orlando, Florida. Orlando completes the list as a market where Zillow data shows sustained pressure on home values relative to national trends. While tourism continues to support the local economy, housing demand depends on long-term affordability for residents. Before the boom, Orlando's market was driven by steady population growth and service sector employment. During the surge, prices rose rapidly, fueled by investor activity and migration optimism. As financing tightened and costs rose, demand softened. Zillow market reports in 2026 show longer listing times, growing seller flexibility, and repeated price adjustments. Buyer psychology has shifted toward caution, with long-term affordability taking precedence over appreciation narratives. Sellers are adjusting to a slower, negotiation-driven market. Properties priced for peak conditions struggle to move, while realistically priced listings fare better. Orlando matters nationally because it encapsulates the central theme of 2026. Markets built on optimistic assumptions must eventually confront economic limits. Across all 10 cities, a consistent pattern emerges. The housing market in 2026 is not collapsing uniformly. It is fragmenting. Zillow's national averages conceal local realities where prices are slipping, stagnating, or slowly eroding. Mortgage rates remain elevated. Affordability ceilings are being tested. Migration has normalized. And ownership costs continue to rise. In markets where prices surged fastest without parallel income growth, even small demand shifts now produce outsized effects. This is not panic-driven selling. It is the slow return of price discovery. For buyers, 2026 rewards patience. Negotiation power has returned in many markets. Buyers who focus on total ownership costs rather than headline prices are better positioned. For sellers, pricing realism is essential. Time on market now carries a cost. Adjusting early is often less painful than waiting. For investors, momentum-based strategies are fragile. Long-term demand, cash flow, and affordability matter more than appreciation narratives. The 2026 housing market is defined not by a nationwide crash, but by recalibration where excess built up fastest. Zillow's data makes one thing clear. Markets are no longer moving together, and local fundamentals matter again. If this breakdown helped you see beyond the headlines, subscribe for continued data-driven housing analysis. And tell us in the comments, which city on this list surprised you the most?